Role of risk manager as distinct from internal auditor. The risk manager is primarily responsible for coordinating the organization's overall risk management framework. This role focuses on identifying, analyzing, and monitoring risks across the organization and ensuring that appropriate risk responses are implemented. A key responsibility includes maintaining the organization's risk register and ensuring that risks are documented, assessed, and regularly reviewed. The risk manager also helps establish appropriate controls and mitigation strategies to manage identified risks. In addition, the risk manager may provide training and guidance to operational staff so that they can recognize and report risks in their activities. The role therefore focuses on proactively managing risk rather than evaluating controls after implementation. The internal auditor performs an independent assurance role rather than actively managing risk. Internal auditors review the effectiveness of internal controls and risk management processes but do not normally design or operate those controls themselves. Their work involves examining financial and operational information, reviewing internal control systems, and assessing whether controls are functioning effectively. Internal audit also evaluates whether organizational activities operate economically, efficiently, and effectively. Because the function is independent of operational management, internal auditors provide objective assurance to senior management, the board, and the audit committee about the reliability of controls and governance systems. Another key difference lies in their approach to risk control activities. The risk management team typically participates in the design and establishment of controls to manage risks and works closely with operational management to ensure risks are addressed. Internal auditors, however, review and test these controls to determine whether they are operating as intended. This separation ensures independence and prevents conflicts of interest. If internal auditors were responsible for implementing controls, they would later be auditing their own work, which would weaken the reliability of assurance provided to the board and stakeholders. The two functions are therefore complementary but distinct within the governance framework. Risk managers focus on identifying risks and helping the organization develop strategies to manage them effectively. Internal auditors assess whether the organization's systems of risk management and internal control are adequate and functioning properly. Their work may also trigger improvements in risk management practices when weaknesses are identified. By maintaining this separation of responsibilities, organizations benefit from both proactive risk management and independent assurance over governance processes. Control systems in functional areas. Control systems exist within different functional areas of an organization to ensure operations are conducted efficiently and risks are managed effectively. These controls include procedures and policies designed to ensure that management decisions are implemented properly and that organizational objectives are achieved. Control activities occur at all levels of the organization and may include authorization procedures, reconciliations, verification checks, and segregation of duties. For example, financial functions often include controls over transaction recording, approvals for payments, and reconciliation of accounts. Such controls reduce the risk of errors, fraud, and misreporting in operational and financial processes. Functional controls often focus on preventing and detecting fraud or operational errors. Preventive controls aim to stop undesirable events from occurring, such as through segregation of duties, restricted access to systems, or strict authorization requirements. Detective controls operate after events have occurred and identify irregularities, for example through reconciliations or internal audit reviews. Corrective controls aim to resolve issues once they have been detected, such as recovering incorrect payments or implementing disciplinary actions where fraud is discovered. By combining these different types of controls, organizations can effectively manage operational risks within each functional area. Control systems also ensure compliance with laws, regulations, and internal policies. Many internal controls are designed to ensure that organizational activities follow regulatory requirements and internal procedures. For instance, controls may ensure that transactions are authorized according to company policy, that records are accurate, and that financial reporting is reliable. Internal audit often reviews these controls to ensure they are operating effectively and that management complies with regulatory standards and corporate governance requirements. This process strengthens accountability and protects the organization from legal or reputational risks. Effective control systems integrate operational processes with risk management objectives. Controls are most effective when embedded within everyday organizational processes rather than operating as separate compliance exercises. When employees understand their responsibilities for control activities and risk awareness is integrated into operational procedures, controls become more effective and sustainable. This integrated approach allows organizations to maintain strong oversight while supporting efficient operations and strategic objectives. Operational features of internal control. A key operational feature of effective internal control is that it should be embedded within the organization's structures, processes, and culture. Internal control should not be viewed as a separate administrative exercise or an isolated compliance process. Instead, it should form part of the organization's daily operations so that all employees recognize their role in maintaining effective controls. Embedding internal control within organizational procedures ensures that risk awareness becomes part of routine decision-making. When employees understand the importance of control activities in achieving business objectives, the internal control system becomes more effective and contributes to improved organizational governance. Another operational feature is the ability of internal control systems to respond quickly to changes in risks. Organizations operate in environments that are constantly evolving due to technological, economic, and regulatory changes. As a result, internal control systems must be flexible enough to adapt to new risks or changing operational conditions. If the risk profile of the organization changes but control systems remain static, the organization may become exposed to new vulnerabilities. Effective control systems therefore include mechanisms to review and update controls regularly to ensure they remain appropriate and effective in managing emerging risks. Sound internal control systems also require effective information flows and reporting mechanisms. When control weaknesses or failures occur, they must be reported promptly to appropriate levels of management so that corrective action can be taken. Effective communication channels ensure that relevant information about risks and control failures reaches decision-makers who have the authority to respond. Without clear reporting mechanisms, control failures may remain undetected or unresolved, increasing the organization's exposure to operational and financial risks. Strong reporting structures therefore support accountability and enable timely responses to emerging problems. Monitoring is another important operational element of internal control systems. Internal control processes must be regularly evaluated to ensure they continue to operate effectively. Monitoring may include internal audit reviews, management supervision, and periodic assessments of control activities. These evaluations help identify deficiencies and enable improvements to be implemented. Monitoring also ensures that internal control systems remain aligned with organizational objectives and risk management strategies. By continuously reviewing control effectiveness, organizations can strengthen governance processes and maintain confidence in their risk management framework.